I do like to start off every show with a summary of what's going on with the market, which is a pretty good thing to be looking at today. So, all right, so let me share our normal screen that we've been looking at here. And, this goes back to 2018. You see that first drop that came just right over the talk money was Tom, symbol there. And then, of course, the pandemic. And then we had that huge amount of money that came out. We had a huge run up, caused some inflation, drop down. So, but look at what we're doing now. I mean, this isn't in logarithmic scale, so that drop looks more dramatic than it is because it's just based on points. The drop that's there for the pandemic was 35%. The drop that we're experiencing right now is a 18.6 or 7% or something like that. So, they're not equated, but they do look similar, right? It's very fast in terms of the downturn. And really, what has happened this week has everything to do with what happened in the Rose Garden on Wednesday after the market closed.
Hmm.
And so, you know, all along we've been talking about it in the show, kind of, what the market would like out of what was talked about on the campaign trail, what the market would not like, on, the campaign trail. So the market, in our opinion, wouldn't like tariffs, wouldn't like really mass deportations, especially out of the construction and agricultural industries, because that would raise prices in both those areas. But the market would like tax cuts, right? Deregulation of different businesses. And so unfortunately, the only things we've seen so far are those things the market doesn't like. And that's what we talked about at the end of the year, was just that there's going to be this gap between those. But this has gone a little bit beyond that, because there is never an assumption that I have seen where we would have the kind of tariffs that have been threatened, let's say at least,
Hmm.
in the Rose Garden on Wednesday. And so the market dropped 4.8% yesterday, 6%, basically 5.97%, 6% today. So you're talking about, an 11% drop, give or take, in a 2-day period since that announcement happened. And the reason is because it was presented as reciprocal tariffs. And this seems to be the thing that's bothering people a lot. It wasn't reciprocal tariffs. So I read one article said the average tariff for US goods going into Europe was 1.9%, along those lines, in terms of what was actually paid. Uh, but we ended up giving them a 20% tariff for the goods coming from Europe into the US. And then, of course, China already had 20% tariffs from this, last
Prior.
month. Yeah. And now they up that another 34%. Now, there's still some things that need to be worked out and what have you. And of course, China responded back today with a 34% tariff on US goods, which is going to hit the farmers really hard, especially the soybean farmers and what have you. So here's what people are really concerned about. It looks like, if you do the math, the way that they figured out the reciprocal tariffs revolves around the false narrative that Trump has had from the beginning, even during his first term, that trade deficits are really bad. These other countries are ripping us off because we're not, they're not buying as much stuff from us as we're buying from them,
Hmm.
right? So if you look at the trade deficit with China, it's 67%. If you divide that by two, you basically get the 34%
Yeah.
that they're using. And so if you go look at all the different tariffs with these different trade deficits with all these different countries, and you divide that by two, that's what we're giving them as a tariff.
Oh, yeah. So you can see like major countries that are very small populations,
Right.
that are big exporters like Sri Lanka, Cambodia, Vietnam. They're getting hit with pretty major tariffs.
Yeah. And they're never going to buy as much. They're just not as big.
Yeah, they just don't have the population to buy as
It's
much.
not possible. So yeah, Vietnam had what, a 49% tariff, and so that was compounded by what has happened today, a couple of pieces. And so we have made a move here. We moved a majority of the assets that we had in equities and stocks and our stock ETFs and such into T-bills, short-term treasuries, and ultra short-term bond ETFs. We use all three of those to kind of divide things up. And what we left behind was positions that had big gains, right? Because we're not there yet, or we really want to take, a $500,000 gain on something. Because the problem with the gains is that you've now guaranteed you're going to lose that money via the taxes that are going to have to be paid because you've realized that gain. It's complex because you also don't want that $500,000 gain to turn into nothing.
Hmm.
So at some point in time, you have to decide. We're not quite there yet. Our model hasn't triggered those type of trades. We also have positions that people want us to keep. We call them legacy positions. There's lots of different reasons for that. So we still have some exposure to the stock market, but for the most part, we've moved out into these, safe areas. And the reason that the compounding, we have a model, we have all these pieces, we try to stay in for as long as possible. I'm not get last summer is a great example, not last summer, summer of 2023 when the
Hmm.
market drops 10% and then it comes back 8.9% in November. It can come back very quickly. That will probably happen here too. And the biggest problem with this particular downturn is that it's manufactured really by one guy for all intents and purposes, and that one person could change their mind and decide to go in a different direction, and all of a sudden we'd have a soaring stock market, right? However, in today on True Social, Trump said, "I'm not going to change my mind. This is what I want to do going forward." Right? Very much so, doubled down on what he's doing right now, and very upset with China for having basically escalating the tariff war. Uh, this isn't something I think we want to sit through. I'm pretty satisfied to sit through this with the clients mostly being in, bonds, T-bills, long-term bonds we've have in our bond side of our portfolio. They're doing great. I mean, they're up, a lot today. That helps offset some of the losses that are happening in the stock market. But all the stuff that was working better than T-bills like Europe and international all got hammered today. So, and we'll talk about, that in a minute, but that's the big difference as far as that goes. And then on top of that, Trump reposted a video today from TikTok uh, on his True Social page, saying that Trump is crashing the market on purpose. He's trying to make it fall 20% this month. Now, I don't know if that's from the high. It wasn't Trump that made this video, but he reposted it as an approval thing, and seems to be quite excited that the market is coming down, at least if you read his words. It feels like this is going to create a great wealth for the US and those type of things. And who knows, maybe there's some point in time where this really does work out great, but unfortunately the change is so dramatic that the market just can't hang out
It
and
has to
wait.
adjust to what the
Yeah.
paradigm shift.
Yeah, the market likes that stability. We had 57 all-time highs last year. We had unemployment right in the basket where you kind of want it in that low fours, that Federal Reserve loves that. Um, and then the other thing that happened today that really kind of kicked things off too was just the Chairman Powell was doing basically a speech in a question and answer period. And one of the questions was, around um, should we be doing something now, because of what's happening? And he said, no, I think we can be patient. We got time. And so this is a Federal Reserve that's always been takes too long to do things. They took
Hmm.
too long to raise rates during that inflationary time period that came up in 2021. They took too long to lower rates. And now probably if they need to lower rates, but the problem for the Fed is that they have a dual mandate, and their mandates can be, he calls it intention, meaning they're going the opposite direction. So one mandate is to have full employment, which for them means around 4% unemployment, right? And so that's roughly where we are. I think we're at 4.2% right now. But the the view of that seems to be that it's going to grow and potentially grow. And then the other one is to have inflation, in this case, core PCE inflation number down to 2%, right? That's their thing. So if you do massive, and these are massive tariffs, I mean, massive, there's no way you're not going to have some form of price increase on
Hmm.
some of these things, in my opinion. And so there's your inflationary bit. And so the Fed would be theoretically raising rates during that period of time. But see, one of the things that happens with big tariffs, for example, let's say you have counter tariffs like you have in China, whoever here working in the US to produce products to sell to China, they're going to be selling less to China with
Yeah,
that kind of tariff.
we've started to hear rumors of layoffs in factory situations that are
Right.
exporters because,
Right.
especially to ones that are revolving about the car industry because of the tariffs with Mexico and
Yeah.
Canada.
Yeah, so that means layoffs in theory, less people working. Now the unemployment rate theoretically goes up. And this is what Chairman Powell was talking about. This is not something I'm making up, but so you have this dual thing happening where, they should be lowering rates to help unemployment. They should be raising rates to
Stop it.
stop inflation. And inflation's sort of artificial, although they are playing a really dangerous game here. Theoretically, there is a window here where they could negotiate and try to come up with some better tariffs on both sides. But the damage is already started even before the tariffs. We're already seeing, we just saw the core PCE number came out last week, and month over month it was at 0.4, right? So if you look at February of this year, which is what the PCE just reported last week, versus January of this year, you got a 0.4% increase on that core. If you multiply that times four, that's 4.8. Okay, we're at year over year, we're at 2.8. So inflation is starting to pick up. Now, it's done that many times and then turned back around, especially on the month by month basis. But what's happening is the expectations for inflation are growing, right? Within the surveys for consumers.
Mhm.
And then that causes people to go out and start to buy things. Cars would be a great example, right?
Yeah, for example, my sister, because of the whole tariff
Right.
thing, she went out this weekend, prior weekend, and bought a car, essentially
Must
two.
must be a great time to be selling cars. I mean, yeah, because I've had many conversations with clients, even just this last week, and they're all scrambling around, kind of accelerating their car purchase decision. Well, guess what? You get, any time that that starts to happen, you have a supply and demand issue. And, I guess as long as you're not selling a Tesla, you probably have some pricing power here.
Yeah.
And, you're going to have potential to raise your costs and because the demand is there. I mean, this is the people are in business to try to make money. And so, that's the danger of where this is because it's weird. I mean, high tariffs have the potential to cause both. Now, again, we had tariffs that happened in 2018, and they were just small enough and on enough weird areas that it didn't matter. But they did a lot of great studies, and they found that there was 173,000 jobs lost because of those tariffs that were put into place in 2018, which just really isn't enough to make a big difference in a big economy like this. But those tariffs were smaller than this by a factor of probably 10 or more. I mean, so then you've got the situation where they did the thing with washing machines. So washing machines were 9% higher after the tariffs, and then as soon as the tariffs were expired, the washing machines dropped back down 9% in terms of So even domestic producers were raising prices
Yeah,
because they can,
they have the pricing power
right?
too.
So it's inflationary potentially, right? It has been in the past, even looking at that 2018, looking at those studies. And again, that was $350 billion worth of tariffs on an annual basis. This is a lot bigger. You're talking 10% tariffs worldwide, 20% to Europe, 25% on some goods or most goods outside of some of the pieces that they've carved out for Canada and Mexico. You have 54% now tariffs on China. So, if you're in Australia, New Zealand, or wherever you are, you've got at least a 10% tariff to get items here into the US. So the market doesn't like it, right? I mean, you can tell that for a fact. So I, I the problem that we're going to have here, especially since we're kind of out of the market for the most part, except for these other pieces that are still there, is that this can turn around tomorrow or Monday. I mean,
Yeah, he could change his mind over the weekend.
yeah, I mean,
Very
he has
soon.
said he's not going to. And I'll tell you what, the thing I'm starting to realize is I think we really have to start listening to him. He's doing exactly what he said he's going to do. And that wasn't always the case. It certainly wasn't the case in the first term. It wasn't even the case early last month. Oh, I'm going to do tariffs and then they get delayed and do tariffs and they get delayed. And it's kind of a weird thing where you're feeling like, okay, this is a negotiating tactic. It still might be a negotiating tactic because sometimes I think once you don't get what you want, you actually have to put the tariffs on,
It's
put them
kind
in
of like
place.
the boy who cried wolf, and
Yeah.
now there's an actual wolf.
Yeah, no, there's an actual wolf. And so, of course, instead of, having a negotiation with China that was going, or China comes in and says, okay, we're going to lower our tariffs if you'll lower yours, They just up theirs. So the market's not going to like that. Unfortunately for me, I think that that means that other countries will look at that and possibly follow along too. Maybe Europe does some reciprocal tariffs on U.S. goods and such too. So it could have gone the other way. That's what I was talking about yesterday. If all of a sudden all these countries said, okay, and we ended up with a much better trade scenario across the board,
Hmm.
that would have been a positive outcome from this. But Trump seems to look at this as an income source, as a way to make money, and it will be, somewhat pain-free, although he has talked about some pain, right? In a couple of the interviews that he did. But when you got him posting a TikTok video on his True Social thing saying that, hey, Trump's crashing the market on purpose, uh, oh, yeah, this becomes real. And now there is one piece out here that I keep reading about in different places. I think it's kind of fascinating. We have 36 trillion in debt. 9 trillion of that debt is coming due this year, 2025.
Hmm.
That debt, I think the average cost of that debt to the US is 2.7% because a lot of it was issued at very low
Yep.
periods. Right now, if you look at the 10-year treasury, it was nearly at 5. Now it's down in the 4. Actually got a little bit below 4 today at some point in time. I'm not sure where it ended up. But one advantage of crashing the economy is that the Fed will have to, and Trump has been yelling on True Social today at Chairman Powell for playing politics and not lowering rates now. They want rates to go down so they can, deal with this debt issue and push out $9 trillion more bonds to pay off the bonds that are coming due and get closer to that 2.7% that they're paying now. It would take something pretty spectacular to do that, but they're working on it. And so uh, there may be some reason for that, for what they're trying to do here. And again, that's probably not something you want to sit through as far as that goes, because it's a pretty dangerous game that they're playing altogether, right? I mean, because you get this type of downturn, and sometimes you just can't just turn it right around. Things can start to go. And I remember Greenspan used to have a saying, when the tide goes out, you can see who's swimming naked,
Hmm.
right? And the concept there is that, when there's lots of pressure, economic pressure, you can see firms start to fold. We saw that in 2008. That's a great example, right? The tide went out, you know, mortgages were falling apart, and all of a sudden Lehman Brothers go out of business. And we were already down 20 something percent at that time. And we ended up dropping another 30% after Lehman very quickly, too. And so that's one of the dangers that they're doing here. You got companies that have a high leverage or whatever that might be. And so again, I think, our model already triggered, but if you kind of look at what is going on, eh, you know, it depends on who you are as to what you should do, right? If you're young and you got a really long period of time, I mean, yesterday, 4.5 trillion or billion, what was the
Billion.
billion dollars came in from individual investors, which is some kind of a record. I can't,
I think a lot of investors from the pandemic got into the habit of
yeah.
buying the dip,
Uh-huh.
and so that mindset still exists.
Yeah, so Nvidia is way down from where it was, could go a lot lower, obviously. But if you look ahead 3, 5, 10, 15 years, it's probably still going to be a good price today. There's nothing particularly wrong with that. The only problem that you have here, and the part that the dip buyers might not completely have absorbed, if you really study the market, you didn't want to dip buy the last depression. It dropped 87%. We're down 18 point something, right? So you do have to be a little bit careful. They call it, trying to catch a falling knife,
Yeah.
right? And so,
Are you
uh,
grabbing the blade or the handle?
yeah, and so it kind of depends on who you are, how aggressive you are, how you want to do that. This could be a great buying opportunity. However, it would be awful nice to feel like Trump saw something happening, said some things, because during his first term, he did a lot of comments that I thought were positive to the market, and the market user responded well too. He hasn't had any of those.
Hmm.
He seems to be wanting, and today he posts that TikTok video. He seems to be wanting
He,
the
he,
stock market to come down.
he did have positive comments. He said Vietnam came to the negotiating table,
Yeah, that's right.
and so you could see companies with exposure to Vietnam industries like Nike had a
Yeah,
good day today.
yeah, yeah,
And so it may companies may just have, depending on their exposure to each country, that's how when
yeah.
tariff situation is resolved, they'll have a bump. but you don't know. It's so everyone's diversified so much.
Right. Well, and that's what I was talking about yesterday. Because yesterday I was like, look, if this is a negotiating tactic, the market could explode upward if everybody that was out there did what Vietnam did today and came to the table and said, we're going to get rid of our tariffs or we're going to do whatever, to make it work. If you get rid of yours, we'll get rid of ours. And boom. So China would have done that and Europe would have done that. And, whoever else has tariffs on us would have done the same thing. The market would have been 6% up today instead of 6% down. And so that's the danger for really dealing with this type of market. This is not a structural issue like the 2008 when everything was falling apart. You couldn't just turn it around. This can become a structural issue. If
Mhm.
they keep these tariffs up for very long, yeah, we'll have a 2008 type scenario where you really can't, again, things will break and we won't be able to, kind of get out of that cycle without some more pain. And so, we'll see what happens as far as that goes. A couple of pieces here. I think this is from last week. So we didn't do a show last week because we had a problem with our computer setup here, which we fixed, which is great. A little hard to see this, but the very bottom, just over Easton's head, that's the S&P for the last 30 days. It was down 4.75%. And I was just trying to point out, look, there's a lot of areas still doing better and better than T-bills because the next one up from, Easton's head there is the kind of red one. That's a T-bill ETF, ticker symbol is
Yeah,
BIL.
it's basically a straight line.
Yeah.
It's a very slight slope.
Very slight slow, up 0.34% in a month. Right? So, but there's all kinds of things: utilities, international, domestic. Large international. We have Europe. We had energy and gold all doing better than T-bills,
Mhm.
right? And so the way our system works is, we want to be in what's doing better, right? And if everything falls apart, T-bills will be kind of up at the top, which is what happened in 2022, for example. Well, here's this week. Okay, 1 week difference, same exact ticker symbols. Only one thing is outperforming now in the last 30 days, T-bills, and that's gold,
Mhm.
right? Now, if you look at gold, it's actually coming down when, in the last, overall for the week, it's down.
Yeah.
And T-bills would have beat it on a 1 week basis. But look at the differential. I mean, you got, energy was up 4, is now down 7. Stock market's down 11, for example. So it's just all of that started Thursday, Friday after hours on Wednesday, Rose Garden, Liberation Day was not good for the stock market, at least so far. And we'll see how that goes long term. Here's something that we do watch also. This is a 1 month return. Same thing for the green line there, right above Easton's head there, or next to him is the S&P 500. And then the red line is the Vanguard Extended Duration Treasury ETF, and the ticker symbol is EDV. What happens is that when and the bond market is actually something to watch. When the bond market starts to come up, and especially the long-term treasuries, the expectation is that we're heading for some type of calamity. So that's what the bond market's predicting. So that red line, you see how it started up pretty heavily there. And so like today, I think this was up 1.8%, give or take for the day, even
Yeah.
though the market was down. Same thing happened the pandemic.
Yeah, it's where investors fly for safety essentially. It's where they think this is the safest investment. Let's just get out of the market.
Yeah, and it's the extreme end of these safety. So the overall bond market could be up, a 1/4% or something, and these could be up 2, right? They generally will follow the overall bond market. And so it's just, but you won't see the bigger runs out of those most of the times unless there's some expectations of some real problems. And so they're going up probably with the expectation that interest rates might be coming down to support the economy. That is what happened the last time we had tariffs back in 2018. The Fed started lowering rates and they stopped doing tariffs, and the market came back in a few months,
Hmm.
which could very easily happen again this time. It's just, again, if we listen to what Trump's saying right now, I'm not going to change my pattern. He wants this to be a revenue source. Peter Navarro is talking about gathering $6 trillion in tariffs. They'll be able to use that to offset taxes and all this. On the campaign trail, he talked about having no taxes, only tariffs, right? And so whether that works or not, the market is going to hate the transition.
Hmm.
So, and it could be quite a period of time before, if it was going to work. Um, and I'm not saying it would. I don't believe it would, to be honest, but I don't know everything. And I try to always remind myself that. And so But if it was gonna work, there's still gonna be this kind of really tough transitionary period that we go through, because prices are gonna go up, very
Yeah.
likely, very soon.
It's because like you could say that everything was inflated. Now it's kind of
Right,
or everyone had what their paradigm was, and now the
right.
paradigm's shifting.
Yeah, exactly. All right, so that's our, sorry, lengthy commentary on the stock market. And uh, it's quite the day, to deal with stuff. So, uh,